Conventional wisdom states that if an investor buys and holds a stock market, they will make money over the long run. The famous figure of the long-term return of the S&P 500 is about 7% in real returns per year. The average investor you speak to expects to get this return annualized over their investing horizon. However, does historical data actually support this? Let's use an example of someone with a 30-year time span. This will be a wonderful result for his retirement. $100,000 invested today will be worth roughly $1.7 million nominally. In real terms, or today's money, it's worth about $760,000. There are a few problems with this. Now, obviously, there are no guarantees in the stock markets or investing in general, but a solid long-term track record is what we are going on here. The first problem with that is, what is that really based on, and is it truly a long-term average that can be reliable and relevant to us? The track record starts in 1926 and ends in present day. The return comes out to be 10%. This is the period the famous figure is based on. Do you consider a period of nearly a century a long-term average? The chart spanning in the 1800s looks somewhat flat. This time period is not often visited by investors, but the U.S. stock market was created in 1817 after all. The second problem with this track record is simple math will tell us that the larger a data set gets, the less shaken that average is by new data points. The implication of this for our markets and our investing horizon is obviously yes, while the average may be 7% real returns over this immortal period of time, assuming it does continue, topic for another video, there is no historical guarantee the average needs to be that for our human investing life of roughly 30 to 40 years. Our 30 years could be horrible, the next 30 years could be stellar. The stellar years, while making the 7% average hold, would not matter so much as retirement closes in for us. Not what he meant when he said this, but I quote, "In the long run, we're all dead." Well, is this point relevant? Has it ever happened in markets? Yes, definitely. I will point out a few periods in this time frame that the U.S. stock market's real return of 7% does not hold for a realistic time period for an investor to buy and hold. For now, let's focus on the U.S. where this metric is actually used. I will be using the earlier example of someone who invests $100,000 for 30 years. I realize no one really does this, but either way, it examines the long-term return for a period accurately. Below, I will include a dollar cost average result at the bottom of each, or where an investor buys a total of $100,000 monthly in chunks adjusted for inflation as they work over their life, but it's not really relevant to our analysis because it's simply aggregating measured returns from a large number of smaller time periods to the end from increasingly smaller endpoints. In most examples we look at, it performs worse simply because you're spending less time in the markets. But that is a topic for another video. Example 1 is the time period from 1912 to 1942. This time period contains the well-known Great Depression as well as the two world wars. There were also two other mini recessions in this period, one after World War I and one before the start of the post-war boom. Let's do some portfolio analysis. $100,000 invested in 1912 held in 1942 with the dividends reinvested would become $538,200. The nominal return annualized for this time period was 5.77%. After accounting for inflation, which did average out to be about 2% in this time period, the returns are about 4%, totaling a real return of $280,679. This is almost half of our 7%. Comparing that to our expected rate of return, not quite right. Example 2 was from 1952 to 1982. So if you look at this time period on a chart, it looks quite good. However, do not forget the Great Inflation. The 1970s experienced a really high inflation, some years being in the double digits. While nominal returns are pretty good, inflation takes a toll on the actual real returns. $100,000 invested in 1952 held to 1982 with the dividends reinvested would become $1,200,000. The nominal return annualized for this time period was 8.66%. Quite good, but still not quite our 9 to 10%. After accounting for inflation, which did average out to be much higher here at 4.4%, the real returns are about 4.2%, totaling again to about half of our 7% expected return in a real return of $343,580. Example time period 3 would be 1964 to 1994. This is roughly the same time period, but will illustrate the effects that inflation still has on the overall nominal return that appears to be about right. $100,000 invested in 1964 held to 1994 with the dividends reinvested would become $1.5 million. The nominal return annualized for this time period was 9.5%, so that's about what it should be. However, roughly in this time period, we also have to account for inflation, which averaged out to be about 5.35%, even larger than the time period before, as the 1950s had some of the lowest inflation that the United States has experienced. The real returns then are about 3.9%, totaling to a real return of about $315,000. So while our nominal return was about average in this time period, inflation proved to be above average, which made our real returns lower than what they should have been. Now let's look at one modern international example. 1990 to present, the Nikkei 225. This is the Japanese stock market. Most people are probably familiar with the Japanese asset price bubble, absolutely soaring to insane valuations throughout the 1980s. It burst in the early 1990s. If an investor were to have bought in January of 1990 and held with the dividends reinvested at the start of 2020, their total return would have been about 25% total, coming out to be about 0.5% annualized. Adjusting for the real rate of return, the return is actually negative 37% or negative 1.5% real returns per year. I will mention the dollar cost averaging example for this because it does make it a bit better as it's in a downtrend, but it still pans out badly if it is a genuinely bad investment like the case of Japan. Okay. So by making this analysis, I must say I am not a gold and silver doomsday prepper. This is absolutely not my case here, and the purpose of this video is definitely not to dissuade an investor from investing in the stock markets. I personally invest in the stock market both nationally and internationally via dollar cost averaging method. It is just a reminder of the simple adage, past returns does not guarantee future performance, and my corollary, the devil is in the details. There are many more examples that could have been looked at, but I will conclude here. The long-term average, while 7%, is frankly misleading for investors and historically would have produced false expectations within an investor's relevant time frame. It fails to distinguish what long-term really means for a human. If you speak to the average investor, they generally expect that they'll get 7% over their lifetime, which very well may not be true, as this historical data, in the grand scheme of things, is not that long and also has plenty of time periods where this was not true. There's simply no guarantees in the stock markets or investing in general, so as always, make sure you diversify and/or evaluate if a particular investment makes sense to you and have a clear plan and expectations going in. Thanks for watching this video, and if you like this video, like and subscribe for more content.